Welcome back to the channel. This is your boy Ahmed at Altcoin Era. We got turmoil in the markets. The Trump tariffs have caused absolute mayhem. But in times like this, I like to zoom out. We need to stop looking at the daily charts, the weekly charts, the monthly charts, even the yearly charts. We're going to really zoom out on what's going to happen in the next 5 to 7 years. So let's begin. The S&P 500 is down, the Nasdaq is down, the Dow Jones is down, the Russell 2000 is down, oil is down, silver is down, DXY is down, everything across the board is down except for Bitcoin. I'll get to that later on in the episode. We got a gentleman on the show. This is the second time he's been on the show, Russell Napier. And this is the second time he's been on the show. I've already spoken about his first prediction, which is still correct. He made this prediction 4 or 5 years ago and it's come true. He's made another prediction in the markets and we're going to go over this today. It's very, very spooky. He's made this prediction on the 13th of December. 3 months later, the entire market is down massively. And we're going to find out why. Then he's still bang on the money. Impressively, he's got this right again. Stay to the end. You're going to enjoy it. Smash the like button. We are heading towards a system of national capitalism. Market strategist and historian Russell Napier outlines a future in which governments mandate where investors should deploy their capital. The global monetary system that has existed since 1994 is being radically restructured. When Napier speaks, investors around the world listen closely. Napier remains convinced that the global financial system is in a process of fundamental change. We're talking nothing less than a collapse of global monetary system as we know it. The interviewer asks, when we last spoke, you said that governments have found the magic money tree. By guaranteeing bank loans, they will create money at will, paving the way to financial repression and inflating away their debt. Is this still your view? He replies back and says, in the long term, yes. Financial repression and inflating away bloated debt levels will be with us for years, even decades. But I think we're experiencing a hiatus first. Governments did exactly what I said in 2021. They created money on a massive scale, but then they panicked. So they handed the ball back to the central bankers and said, do something about it. In my opinion, central bankers have done too much. They hit the brakes too hard. Hence, my fear that we might be facing a deflationary shock in the short term. The interviewer replies and says, you're saying central banks have tightened too much? Yes, we've seen a collapse in growth of broad money in magnitude that we haven't seen since the 1930s. Now you might say that this doesn't matter since so much broad money was created between 2020 and 2022, and clearly it hasn't mattered for the past 2 years, but now it's starting to bite. That's my evidence that we have over tightened. Both in the US and Europe, M2 supply has picked up again. Central banks have started cutting rates. Why do you still fear a deflationary shock? He replies back and says M2 supply has picked up, but it's growing too slowly. It will need to accelerate. The level of M2 growth in relation to the current level of interest rate is just not compatible with what we needed to sustain economic growth. The interviewer asks, inflation shows signs of stickiness. Do you think any inflationary wave might be in the making? And he replies back, if we were to suffer a supply shock, then inflation will go up. Regardless of what broad money does, the absence of that. If broad money is not going up, it suggests that economic activity is going to weaken. I always look at things through a monetary prism. In my view, the next shock is more likely to be deflationary. In layman terms, he's saying that inflation is not heading back. It's under control and it's done. Now he's fearing. The interviewer asks, where could that shock come from? He's replied back and says, we could hypothesize about that all day. It could be the French bond yields, it could be China, it could be the cash and carry trade, and there's possibilities that it's the unknown. So somebody somewhere gets into trouble and we see something break in the financial system. So basically, you are saying that we first might experience deflationary shocks before we go back to a world of higher inflation. And he says, yes, my longer term view of financial repression remains unchanged. That's the only way I see that would lead us out of a record high level of debt. The world has massive, massive debt, huge debt. Some folks are highly indebted. Yeah, you and I, so many people, they have so much massive debts. If it's not mortgages, if it's not personal loans, student loans, a lot of folks are in massive, massive debt. And the government has to find a way to deflate that debt. So he continues and says, use the term deflationary shock. I'm not sure we will see outright deflation. Deflation shocks are bad for the economy. They are ugly for equities, and they are very, very dangerous for high levels of debt. You don't make money as an investor by trying to predict deflationary shocks. You make money by anticipating the government's reaction to deflationary shocks. And I'm convinced that governments will react swiftly by forcing banks to to lend, by suppressing interest rates, and by using national savings to invest in things they want. The interviewer continues and says, what are the signs of this? Like, what kind of evidence do you have? He replies back by saying that the world is shifting. Macron in France held a speech and he said, Europe, it can die. All right, it's a massive, massive sea change. Europeans spend 300 billion euros to send to America and their corporations. In other words, he's outlining a concept of national savings. The British, meanwhile, are talking about mandations, which posits that pension funds in Britain must invest in certain percentages of their fund domestically. That's what lies ahead. Governments will tell investors how and where to invest their capital. The interviewer continues and says, and that is what you would call or define as financial repression, correct? And he agrees and says, yes, we're going to get national capitalism. Russell continues in this article and says global national debt and GDP is at 200%. 311%, 255%, and Japan has a whopping 400%. We are talking about at least a decade and a half to get this under control. For Japan and France, it's going to be much, much higher. Do you see the possibility that technologies such as AI will create a productivity boom, lifting real economic growth, which will help our economies to grow out of debt? And then he replies back and says there are only 5 ways out of a debt problem. The first one being austerity, second one is default, the third one is high growth, fourth is hyperinflation, and the last one is financial repression. Austerity is terrible. Default is garbage. High growth is the only way out of a debt problem. Hyperinflation, you know what that is. And financial repression, that's what we are in at the moment. He continues and says, you need a productivity revolution. We need to lift real growth to 3 to 4% per annum. Will AI deliver? He doubts it. Okay, he doesn't believe in it. Look at the internet revolution. It has transformed the entire world. It didn't boost productivity. There's an interesting book by my friend titled Entire Engines That Move Markets. He goes back to the railway boom in the 19th century, and he says a very consistent pattern. When a new technology appears, it attracts huge amounts of capital. There's a physical investment on a massive scale. This inevitably leads to overinvestment, creating bad returns, and then the whole thing collapses. It's usually in the ruins of the first investment bubble where you can identify the truly productive uses of the new technology. Think of Amazon. Today is a clear winner of the internet age. But from 2000 to 2003, its share prices fell by 90%. Will AI be different? I'm not smart enough to work that out, but I doubt it. I'm definitely going to have to disagree with you there. I agree with many of your macroeconomics, but when it comes to tech, I'm gonna have to pass. I'm gonna have to agree to disagree, but nonetheless, let's continue. You mentioned that you see a world moving towards a system of national capitalism. This will upend everything that most investors today take for granted. Free flow of capital, market-based bond yields, and the like. He continues and he speaks about China and how China is changing. Then he continues to talk about how China is going to be completely different now. The interviewer asks, what will the new financial order look like? Let's deal with China first. China will separate from the rest of the world. They will want to adopt a truly independent monetary system, monetary policy of their own. They will need much looser monetary policies. That's what he says. And they need to inflate away their domestic debt. And by simply using the exchange rates, they're going to lower the exchange rates. All right. Then he continues and says that the renminbi is no longer being used. It's not actually being used. He says that every quarter he sees the information from the IMF and it shows that it's not happening. Beijing may be setting up a system where countries can settle trade in renminbi. But so far, all the evidence we have is that no one is holding the renminbi as a reserve asset. And I understand that China really wants to move and transition into a reserve currency. At the moment, it's the dollar, the mighty dollar. The interview continues and it talks about capital control. All right. So we're going to be in a system where it has to be a system that allows inflation and suppression of domestic interest rates through the use of national savings. Okay. So which means that we will have forms of capital control. In today's world, where most financial assets are held by institutions, capital controls can take the form of regulation. Think of your government regulator mandating all pension funds to buy a certain amount of government debt or domestic financial assets. That is what national capitalism looks like. The interviewer replies back and says that's ghastly. It won't necessarily feel bad for the whole population, at least for the first several years. Remember, governments want to channel a lot of capital investment into their economies while slowly inflating away their debt. This system is terrible for savers, but it won't feel so bad for blue-collar workers. I repeat, it won't feel so bad for blue-collar workers. An active equity investor can benefit from the redistribution of wealth from savers to workers and from the older generation to the younger generation. This is the main event. As investors, where should one invest in? Then he goes on to talk about interest rates and bonds. Bonds are going to be in a 40-year bear market. No surprise there. What to buy? What shall I buy? He replies back and says, gold is up 30% already this year, and I still want to own even more gold. It's an outstanding asset. I'm talking about nothing less than a breakdown of the global financial system we've seen since 1994. When the Bretton Woods system broke down in 1971, gold went from $30 to a whopping $850. If you calculate that, that's a massive 28x. 28x. That's more than Bitcoin's return this cycle. 28x. Gold will go up. We haven't seen that move yet. I've spent 2 weeks talking to fund managers, and I can tell you they're really not into gold. And of course, the largest part of your portfolio should be in equities. Which equities should I own? This is a tricky one. He goes down and he says this, very, very interesting. He says, because if we move into a world where every developed world savings institution has to repatriate assets to buy bonds of their own government, they will need to liquidate the one asset they have all crammed into in the past years, the S&P 500. Over the past year, all the world's institutions, investors, everyone has crammed into the Magnificent Seven. If they are mandated to own domestic stocks, they will be forced to sell US assets, not buy the S&P 500. The interviewer replies back and says, because these are assets that we are going to liquidate. And then he replies back and says, yes, it starts at a historically high level, who may be forced sellers. So what would you own? Equities that won't be liquidated, because they are not overly represented in portfolios of institutional investors. The unloved, unowned assets. I'm talking about the mid and small cap. This is the price action of gold. Let's compare gold and BTC, because this year it has to really show if it's really a competitor to gold. I know this is the contrarian. Many participants believe that Bitcoin is just a technology play. It's just the Nasdaq, but with 3x leverage. There are some similarities between gold and Bitcoin. I believe that Bitcoin is going up higher this year. We might just see this year if Bitcoin is actually a competitor to gold. And he continues and says, what should we own? Equities that won't be liquidated. He says, get into equities that are unloved, under-owned assets, mid and small caps. The typical fund manager has 40% in bonds, 60% in equities, and of which half is in the S&P 500. They're all crowded into the same assets. In order to do well in the big structural change that I see coming, you have to be radical in your portfolio. No bonds, no S&P. I repeat, no bonds and no S&P 500. Buy equities that no one wants today and own much more gold. I definitely agree with Russell on this point. I think it's overvalued, the S&P 500, and there's too many foreign players. They're going to move to the Russell 2000. They're going to move to smaller caps and mid caps. I definitely agree with that. And they're going to move to the Russell 2000. Our research has shown that the Russell 2000 has a massive correlation to Ethereum. As you can see here, whenever the Russell 2000 goes up, so does Ethereum. And whenever it goes down, so does Ethereum. Ethereum has the largest stablecoin market share. It has real world assets, DeFi, and more institutions actually use Ethereum. However, for some reason, Ethereum is still under 2,000. I certainly think this will change this year. I'm going to end with this. A little more than 2 years ago, there was a lot of talk about a renaissance of value stocks. Then seemingly out of nowhere came the AI theme, and investors plowed back into the Magnificent Seven. He replied and said, indeed, Nvidia is over 200% this year. But look at Mitsubishi Heavy Industries. Its share prices is up a whopping 180% this year. Obviously, Nvidia gets all the big headlines. But underneath the surface, some of the big shifts connected to the Capex boom cycle are coming through. The shift is unfortunately masked by the success of the Magnificent Seven. My target still stands, folks, and we're heading to 94,000 US dollars. I know many participants are too scared, because on Monday we might even drop another 30%. The S&P 500 might continue to drop, whereas Bitcoin is just waiting for the S&P's reaction overnight, and then we're going to head down lower. As of now, my target still stands, and Bitcoin is heading much higher.